Does it change your sentiment on floating rate deals where you're like, going forward, we're just not going to do them? Or it's just, hey, this was a fluke of a 18-month period and it's unlikely to ever repeat itself, and floating rate has its place in the tool belt type of.
Yeah, I believe both of those answers are true, that this was a fluke. When was the last time anybody saw interest rates? Look at SOFR, for example. 2 years ago, SOFR was at 0.05%, 0.05%. Now it's 5.3%. That's about what, 1,010x movement in 2 years. No one that I was ever talking to was predicting that. And I don't think anybody saw that wide of an interest rate movement happening in that narrow of a period of time. So in a sense, yes, that is a bit of an anomaly. It's also the worst case scenario for a floating rate debt borrower is to have interest rates increase rapidly in a short period of time, shortly after taking out your loan. That's like the absolute worst case scenario. And that happened to a lot of people, myself included. But it's also, it's part, in one sense, it's also part of the risk. But in another sense, the alternative to that fixed rate debt or floating rate debt is fixed rate debt. Now, let's first separate bridge debt from floating rate debt, because people often get those two confused. They're not one and the same. Bridge debt is a floating rate debt product, but it has a very short maturity. I've never been a proponent of those. Don't like them at all. They're kryptonite. Those will kill your deal. Floating rate debt with a long-term maturity has a lot of advantages. And if you look at data over a long period of time as to which one usually wins the day, long-term maturity floating rate debt is generally more advantageous than fixed rate debt. It's financially going to be more advantageous, except in times when you have this black swan event happen. Now, if I were buying today, would I go fixed or floating? It's going to be a surprising answer. I would probably go floating. And that's because if rates trend down, yield maintenance penalties on fixed rate debt is going to become astronomical. You're going to be locked in at the top, and you're going to have massive yield maintenance penalties. It could prevent you from selling or refinancing, or would suck all the profit out of your deal. And that's the flip side risk. And the big challenge that I have right now is floating rate interest rates are actually higher than fixed rate interest rates right now. So it makes acquiring make almost no sense, because locking in debt at the top doesn't make sense. Paying more for your interest than a fixed rate doesn't make sense. And just the overall rates don't really make a lot of sense, which is part of the reason why we're sitting on the sideline.